You know, when most people think about trading, they're probably thinking about picking the next hot stock, right? But the pros, they see it completely differently. For them, it's a numbers game. So today, we're going to pull back the curtain and look at the actual math that separates the long-term winners from everyone else who, well, ultimately crashes and burns.
So let me ask you this. What if there was a betting system that felt absolutely foolproof? A strategy so simple, so intuitive for a coin toss game that it seems like it just can't lose. It's an idea that has tempted gamblers and traders for centuries. But the real question is, does it actually work?
Well, it's called the martingale system, and here's how it works. You bet $1. If you lose, no problem, you just bet 2. Lose again, you bet 4, then 8. The logic feels rock solid, doesn't it? I mean, eventually you have to win, and that one single win will wipe out all your previous losses and even put you ahead. It feels like a mathematical certainty.
But there's the catch, and it is a massive one. A string of losses, and trust me, they happen way more often than our gut tells us, causes your bets to grow exponentially. You start by betting a single dollar, but after just a few losses, you are suddenly risking thousands, then tens of thousands of dollars, all just to win back that original $1 profit. The hard truth is, the system only works if you have infinite money. For everyone else, it's a direct path to ruin.
And this leads us straight to a core mathematical concept called gambler's ruin. And it's a harsh truth. It basically says that if you have a finite amount of money, even if you're playing a game where you have a slight edge, you will eventually and inevitably go broke. So overcoming this specific problem, well, that's the real secret to successful trading. Okay, so if the simple tricks don't work, what does? Well, the very first step is to unlearn a major misconception that so many beginners have. The goal is not to win as often as possible. And this quote just gets right to the heart of it. Chasing a high win rate can feel really good, it can feel safe, but it is such a dangerous trap because it can hide a strategy that is actually bleeding money. The real metric of success is something else entirely. And this is it. This formula right here is the engine of any profitable system. It's called expectancy, and all it does is tell you the average amount you can expect to make or lose on any given trade over the long run. It perfectly balances how often you win and lose with how much you win and lose. Now this is where the whole concept really clicks. Take a look at System A. It wins 80% of the time. That sounds amazing, right? But its small, frequent wins are completely wiped out by just a few really large losses. It actually has a negative expectancy. Over time, it's a losing game. Now, look at System B. It loses more often than it wins, which, can be psychologically really tough to deal with. But its wins are so much bigger than its losses that it ends up with a really strong positive expectancy. This is the winning system.
So the goal is to build a system that has a positive expectancy. But how do modern, sophisticated traders actually do that? Well, they don't guess, they don't rely on gut feelings, they engineer it. The cutting edge of finance actually borrows a lot of principles from engineering, specifically this idea of a feedback control loop. They use it to create systems that are designed from the ground up to have a durable positive edge, one that can withstand all sorts of different market conditions and shocks.
I know this diagram looks pretty complex, but the idea behind it is incredibly simple. Just think of it like a thermostat for your trading account. The system is constantly taking in feedback, the gains and losses from its trades, and it uses that data to automatically adjust how much money is being invested. It's a self-correcting loop, and it's designed to maintain that mathematical edge, all without human emotion getting in the way. Okay, so let's say you've done all the hard work. You've built a system with a solid positive expectancy. You're ready to start making money. But what if I told you that you could still go broke? This is where everything really comes together. Here's the crucial point. Your success doesn't just depend on what you trade. It depends even more on how much of your capital you decide to risk on each and every trade. This is called position sizing, and I'm telling you, it is the single most important and most overlooked key to long-term success. So let's make this crystal clear with a simple game. The odds are clearly in your favor. Heads, you win $2. Tails, you only lose $1. It's a 50-50 coin toss. This is a game with a fantastic positive expectancy. So we give 3 traders, we'll call them Peter, Paul, and Mary, $100,000 each to go play. Now they're all playing the exact same winning game, but they each choose a different bet size. Peter is conservative. He only risks 10% of his capital on each toss. Mary is aggressive, risking a big 40%. And then there's Paul. Paul risks 25%. And after just 50 trades, the results are absolutely mind-blowing. Peter, the conservative one, and Mary, the aggressive one, they end up with the exact same amount of money. It's a great return, no doubt. But then look at Paul. He's sitting on nearly $2 million. He played the exact same game, but his results? They're in a completely different universe. How is that possible?
While Paul knew the secret of something called the Kelly criterion, or optimal F, for any given system, there is a mathematically precise fraction of your capital to risk that will maximize its long-term growth. And in this particular game, that number was 25%. Peter bet too little, and he left huge profits on the table. And Mary? By betting so aggressively, her losses during the downturns were so large that her growth was completely crippled. She took on way more risk only to end up with the same return as cautious Peter.
So the answer is just to calculate your optimal F and bet, that amount every time, right? Well, not so fast. The mathematical ideal and human reality are two very, very different things. The problem with betting the full optimal amount is that the ride is just incredibly volatile. The swings in your account, what we call the drawdowns, can be so massive and so gut-wrenching that almost no one can actually stick with it without panicking. And that brings us to this concept of drawdown. It's just the drop your account takes from its highest point. And what this chart shows is that the longer you trade, the more certain it is that you will experience a deep, painful drawdown. It's not a matter of if, it's a matter of when and how big.
And a big reason for those drawdowns is losing streaks. This chart shows that even the best, most profitable systems have them. It is a statistical certainty that you will eventually hit a long string of losses. And if you're betting too aggressively when that happens, you simply won't survive to see the recovery.
And this is exactly why most professionals don't bet the full Kelly. They use what's called fractional Kelly. They calculate the optimal amount and then they deliberately bet just a fraction of it, say a half or even a quarter. Sure, they sacrifice some potential peak growth, but in exchange, they get a much smoother ride and a dramatically lower risk of blowing up. So let's just recap the crucial takeaways here. First, forget about your win rate. Focus only on having a positive expectancy. Second, think in terms of operating a system, not just making individual trades. Third, your bet size is just as important, if not more so, than your entry signal. And finally, prepare for drawdowns. They are a natural and unavoidable part of any winning strategy. And that leaves us with one final crucial question to ask yourself, and it's a shift in perspective that makes all the difference. Are you caught up in the emotional roller coaster of just trying to win the next trade, or are you focused on calmly and mathematically running a system that's profitable over the long run?